When you look at a company's finances, it can feel like you're trying to read a story written in another language. But what if I told you there's a single number, a first clue, that analysts always hunt for to see if a business is actually healthy at its core? That's what we're diving into today.
Think about a company's financial report. It's this maze of thousands of figures, all screaming for your attention. So where do you even begin? Well, seasoned analysts have a trick. They have a starting point that just cuts right through all that noise. It's called the gross profit margin, and it tells this really crucial initial story about whether a company can genuinely make money from the stuff it sells.
So here's how we're going to break it all down. First, we'll get the big idea, the why behind it all. Then we'll decode the formula. Don't worry, it's simple. After that, we'll explore what high and low margins are telling us, uncover some hidden stories in the numbers, and finally, see how this one clue fits into the entire profit picture.
All right, let's jump in. Before we even think about touching a calculator, we have to get our heads around the core concept. Why this number? What makes it so incredibly important?
Okay, let's make this super simple. Imagine you own a bakery. Your gross profit is the money left over from selling a loaf of bread after you've paid for only the direct ingredients. We're talking flour, yeast, water, and the baker's labor to actually make that one loaf. We're intentionally, and this is key, ignoring the rent for the shop, the marketing flyers, and the accountant's salary. It's just the pure, unfiltered profitability of the bread itself.
So how do we actually calculate this thing, this powerful little number? Well, the mechanics are surprisingly straightforward. Let's break it down.
It's really just a two-step process. First, you figure out the gross profit. You take the net revenue, now that's your total sales after accounting for any returns or discounts, and you subtract the cost of goods sold, or COGS. Then, to get the margin, you just divide that gross profit by the net revenue. And remember, using net revenue is so important because it gives you the real picture of what the company truly brought in.
And what's really fascinating here is how that cost of goods sold can mean totally different things depending on the business. For a company making a $50 pair of shoes, COGS is tangible stuff, right? It's leather, rubber, factory labor, and they're left with a 70% margin. But now look at an accounting firm that charges $500 for an audit. They don't have raw materials. Their direct cost is the auditor's salary and maybe some software hosting fees, which gives them a massive 80% margin.
This really drives home the most crucial point. It's all about what's left out. The gross profit margin deliberately ignores all the other costs of just running a business, the overhead. Things like marketing budgets, the CEO's salary, the rent on that fancy corporate headquarters. All of that is super important, of course, but it's not part of this specific calculation. The whole point of GPM is to isolate one single thing, the raw profitability of making and selling the product.
Okay, so now we know how to get the number. But what does a high or low number actually mean? What kind of signal is it sending us? What's a good margin anyway?
Well, a high margin basically shouts one of two things at you. Either this company has serious pricing power, they can convince customers to pay a premium, or they are absolute wizards at controlling their production costs. Either way, it creates this big, healthy financial cushion to pay for everything else. On the other hand, a low margin, it kind of whispers a warning. It suggests intense competition or maybe rising costs and production problems. It puts a ton of pressure on the rest of the business just to keep its head above water.
And this right here is a brilliant example of why you can never ever look at this number in a vacuum. A 17% gross margin might be fantastic for a car company, but it would be an absolute train wreck for a software company. And the reason is their cost structures are just fundamentally different. To build a car, you need tons of steel and labor for every single sale. But for a software company, the cost to sell one more copy of their app is pretty much zero. That's why context is king.
Okay, now for the real analyst-level insight. That gross profit margin you see on a financial statement, it's not always the whole story. Believe it or not, it can actually be shaped by the accounting choices a company makes, especially when it comes to inventory.
So picture this. It's a time of rising prices, and the raw materials a company buys are getting more expensive month after month. The company has a choice to make. When they sell a product, do they account for that sale using the cost of their oldest, cheapest inventory? Or do they use the cost of their newest, most expensive stuff? As we're about to see, that decision can make the numbers look wildly different.
And this is that classic battle between FIFO and LIFO. With FIFO, which stands for first in, first out, you're assuming you're selling your oldest, cheapest inventory first. This makes your cost of goods sold look lower, which then makes your gross profit margin look higher. It looks great on paper. But with LIFO, or last in, first out, you assume you're selling your newest, most expensive inventory first. This gives you a lower margin, but honestly, it's often a much more realistic picture of a company's current cost reality.
Okay, so we've established that gross profit margin is a powerful first clue, but it's not the end of the story. To really get the complete picture, we need to follow the money on its entire journey, from the top line all the way down to the bottom line.
I think the best way to visualize this is as a profit waterfall. At the very top, you have this huge pool of revenue. And as we move down, different types of costs start to drain that pool away, showing us exactly what's left at each and every stage. So, our waterfall starts with gross profit. This is the first, widest part of the stream. It shows us the pure, unadulterated profitability of the core business itself.
Okay, next up, we subtract all those overhead costs we put aside earlier. You know, the marketing, the admin, the R&D. What's left gives us the operating profit margin. This is huge because it tells us how efficiently the company is actually being managed. If you see a massive drop from gross to operating profit, that's a huge red flag. It tells an analyst the problem isn't the product, it's that the corporate spending is totally bloated.
And finally, at the very bottom of the waterfall, after we've taken out interest payments on debt and paid all the taxes, we get the net profit margin. This is it. This is the famous bottom line, the actual final profit that belongs to the company's owners.
So when you look at these three margins together, it's like you're handing an analyst a complete diagnostic toolkit. If the final profit looks weak, they can just walk right back up that waterfall to find exactly where the leak is. Is the net margin the problem? Okay, and you're probably looking at a debt or a tax issue. But what if the operating margin is weak, even though the gross margin looks great? Aha! The problem isn't the product, it's all that corporate overhead. And if the gross margin itself is where things start to fall apart, well, then you know the problem is fundamental. It's with the core product itself.
And this really gets to the core of it all. Just chasing revenue for the sake of revenue is such a classic business trap. £1 billion in sales means absolutely nothing if it costs you more than $1 billion to get there. It is the quality of that revenue, how much you actually get to keep, that truly defines a healthy business. And your gross profit margin is the #1 measure of that quality.
So I'll leave you with this question. The next time you see a big headline about a company hitting record-breaking revenues, don't just get impressed. Ask the analyst's question. Yeah, but what's the margin? Because now you know exactly what secrets that one little number can unlock. Thanks for tuning in.